Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Ronald-Peter Stoeferle of Incrementum. Ronnie is a managing partner and investment manager of Incrementum. Together with Mark Ballack, he manages a global macro fund, which is based on the principles of the Austrian School of Economics, and has recently launched a permanent portfolio, an all-weather portfolio. Welcome, Ronnie.
Hi, Richard. Happy New Year.
Happy New Year to you. And lots is happening in the new year. Just was wondering on getting your thoughts going into the new year, how you see the macroeconomic situation and the investment environment.
Well, it's to say at least it's interesting. What happened in 2016 and also what's probably going to happen in 2017. It's all about politics. We have seen quite a lot of drastic changes last year. We have seen the Brexit vote in the UK, which was quite a shock to the international markets. And of course, we have seen the election of Donald Trump. And 2017, political uncertainties will mostly come from the Eurozone, where we've got elections in France, in Germany, and in the Netherlands. So I think from a political point of view, there will be much more surprises coming in. In Germany, for example, at the moment, we have seen inflation numbers in Germany surprising significantly on the upside. So the biggest newspaper, the Bild, which is very much of a tabloid, they are putting enormous pressure on the ECB to start hiking rates again. So I think it's gonna be quite an interesting year, and from our point of view, this interplay between inflation and deflation will be crucial for investors. We have seen that inflation numbers, but also inflation expectations were picking up significantly the last couple of months, while the enormous strength in the US dollar, but also I would say that the major correction in the bond markets acts very deflationary. So I think this interplay between inflation and deflation that we call monetary tectonics is continuing to be crucial for investors. And what's quite interesting is that our incrementum inflation signal, it switched to disinflation, so falling inflation rates a couple of weeks ago. So from our point of view, there might be some surprises, not on the inflationary, but rather on the deflationary side going forward. And I think our signal is very much contrarian, because nowadays it seems that the mainstream is becoming concerned with inflation, while from our point of view, deflationary forces are much stronger.
Do you see those tectonics as being a long-term tug of war, and will there be any resolution, at least whether in the short term, medium term, or long term?
Well, at the end of the book, or let's say at the end of the zero interest rate trap, it's going to be inflation. Every fiat money system in the history collapsed because of inflation, not because of deflation. However, we can imagine that there might be some sort of a deflationary shock. And what will central bankers do? They will act extremely inflationary, and this might be the tipping point when people finally lose trust in fiat money. I think that we are seeing gold being in a bull market again, in a very early stage of a bull market. I think we have seen this accumulation phase 2015, and now we're at the beginning of the party. We're at the beginning of the public participation phase, and this also means that gold will outperform or will rise in purchasing power versus fiat currencies. And actually, gold was up 8% in dollar terms last year. It was up 12% in euro terms, and it was up 30% in British pound terms. So it hasn't been a bad year for gold. And already since the beginning of the year 2017, in dollar terms, gold is up 3%. That's quite good, I would say.
Yeah, and I think also for gold stocks are up something like, in some cases, 80% last year.
Yeah, absolutely. And they have a quite a run since the beginning of the year. So there's quite some divergence. I think the fact that the market became very, very bearish on gold again the last couple of weeks is a good sign. We have seen major, I would say, a sell-off that we can see in the commitment of traders report. So speculative positions were cut dramatically from, I think, 300,000 contracts down to roughly 100,000. So that's a very good sign, and I think that the market is still very, very cautious or negative on gold, and that's a pretty good sign. So I think it's actually going to be a great year for gold, but I'm even more bullish on silver.
I see. You have a great quote in your recent newsletter, coming back to what you mentioned about printing money and inflation, where you mentioned once an economy is chronically burdened by excessive debt and interest rates have reached the zero lower bound, there is de facto no alternative to printing until inflation kicks in. Can you elaborate? Yeah, that's a great quote. Can you elaborate?
Well, of course. We're basically, we all know that at the moment the US dollar is still a leading global currency. It has been locked into falling inflation and a falling interest rate trend for more than 3 decades. And within this super cycle, we can single out the following 2 observations. First, rising interest rates driven by higher inflation expectations have almost always first either led to recession in the US or triggered crises in excessively leveraged regions, at times with supra-regional implications and feedback effects for the US. So normally, strength in the US dollar, and the US dollar index is trading at a 14-year high. This will affect emerging markets as the weakest link first, and we are seeing enormous stress in Mexico, of course, in Turkey, in countries like Egypt, but also Brazil and so on. So those disruptions will come back like a boomerang to the US, and this is going to have effects. And we all know that we're in an interest rate trap. The Fed's, for some reason, it's still talking very hawkish and acting very dovish. At the beginning of last year, everybody believed that there will actually be 4 rate hikes. How many did we see last year? Only 1. And it's the same this year for some reason. What's this movie called with Bill Murray? Where he's experienced Groundhog Day.
Okay. Yeah. Okay.
Where he's experiencing every day. It's like in a loop. It feels like in that movie, because now at the beginning of the year, the whole world believes that there will be 4 rate hikes again. For some reason, markets, they want to believe. I just don't see it. And if they should really deliver more rate hikes, the dollar will go through the roof. And we always said the dollar is the most important driver that one should follow in the markets at the moment.
Yeah, exactly. And ultimately, from the money printing resulting in inflation, this is something that Jim Rickards has pointed out in terms of governments using that as a way of reducing the burden of government debt. So as long as you have an overall inflation rate higher than the interest rates, Jim Rickards points out a 4% inflation rate kept for 10 years can reduce the burden of debt by 1/2.
Yeah.
Is sort of the rule of thumb. So this is one of the pillars of financial repression as we see it. So we may be having a transition from sort of zero, very low interest rates to a forced inflation, but still a very negative real inflation, very negative real interest rates.
Of course, but this is also going to go hand in hand with social upheaval and definitely more socialist politicians, because 4% inflation, like real 4% inflation, that's gonna hurt average people most. For rich people, they don't care because they are diversified, they own real assets and so on. But for Joe Sixpack, this is gonna be a big problem, and this is probably gonna be the point in time when it really gets ugly.
Yeah, and you make reference to that in your newsletter as well. The idea of polarization in society in many places around the world resulting from unsustainable monetary system. Can you elaborate on that?
Sorry, I didn't.
Basically, a societal polarization. That's happening on a global basis from unsustainable monetary systems.
Well, it's we said that many things that we can we can see in the world today. The root cause is coming from our central banks and the monetary system. So we wrote in the last piece, The Legacy of Cantillon, Follow the Honey, and it basically says, the Cantillon effect basically says that where the money is created first, those regions profit from. Normally, this is financial hubs, cities like Zurich, like New York, like London, where people really profit from monetary inflation that leads to asset price inflation. So this is the reason, from our point of view, that's our interpretation, why there's not only in the US but also in the UK, the places where the honey has been flowing first, generally speaking, urban areas, they have significantly benefited from the reflation of the money supplies. So those subsidized regions, they have also been among those that have been given access to the honey through the back of the fiscal deviation of funds. And this is the reason why, for example, in big cities like New York or London, people mostly voted for the status quo, which is for remaining in the Eurozone, and for Hillary Clinton, while in rural areas where people suffer from this monetary inflation, they voted for change. So perhaps that's not easy to grasp, this concept, and perhaps I should refer to our investors letter where we're describing those views.
And do you think that this coincides with a change of views from monetary policy stimulus to fiscal stimulus, with fiscal stimulus being focused in, as you mentioned, like the rural areas for manufacturing centers?
I think if you read the papers that were published in the last couple of months, Geneva report, also those things that that economists put out. I think one of the main findings was that central banks basically that did their job, and now it's time for politicians to step in and to do infrastructure spending and to classic old story debt-based fiscal stimulus, basically Keynesian economics 101. And of course, Donald Trump, that's basically his economic program. I am not that positive, honestly, because there's often the comparison made between Donald Trump and Ronald Reagan. And I think this is the starting position could not be any more different because Reagan had basically falling rates. When he started, he had interest rates for the 10-year treasury bonds at 10%. The S&P 500 price earnings ratio was at 7, and government debt was 800 billion. And relative to GDP, it was 30%. Now, at the moment, we've got interest rates when Trump will be inaugurated at 2.3%. We've got the S&P 500 price earnings ratio at more than 20. We've got government debt at 19 trillion, 19.8 trillion, and to GDP, it's 105%. So we are seeing declining marginal utility of new debt. And therefore, I think that this big program, the tax cuts as well as the infrastructure spending, will only have a very, very short-lived effect. And therefore, I think that this is quite a bold call, but I think that sooner or later in the US, there might be a recession, perhaps in the second half of 2017 already.
And so is all of this resulting in a stagflationary global economy? Do you see that with rising inflation and slowing economic growth?
Yeah, I think stagflation is something that we really should focus on. And of course, mainstream economists would say that stagflation is totally impossible, but we have seen it in the 70s, and I think stagflation is from my point of view a very, very realistic scenario. I cannot rule out that inflation rates, also due to the base effect, rise to 3.5, roughly 4% in the next couple of months. If economic activity is cooling off, and that's what we are seeing. We're already in stagflation. And we're seeing nowadays so many countries being in stagflation. The UK, for example, many emerging markets, the Eurozone in some parts. So I think people should really prepare for stagflation. We wrote quite a lot on stagflation. And you know what works pretty well is, of course, precious metals. Stocks in general, they leave what we call the comfort zone at inflation rates of 3%. So once we get over that level, it's a negative environment for stocks. And of course, you have to differentiate. Some sectors profit from inflation, some suffer, but as a rule, higher inflation rates are not a positive environment for stocks in general.
Yeah, and not to mention that with rising interest rates, it's going to increase the cost of money and the cost of funding, which will dampen many of the infrastructure spending initiatives around the world.
Yeah. Yeah.
Yeah. Yeah, exactly. And Turning to China, how can China affect all this macroeconomic view? It's been recently highlighted by Moody's that right now non-performing loans are running at something between 15% to 20% of GDP levels. So China has enormous debt challenges, perhaps the beginning of a credit bubble bursting. What are your thoughts on China?
Yeah, perhaps the credit bubble already bursted. We have seen that there's very, very aggressive fiscal stimulus in China. We have seen that credit growth basically only came from the state-owned banks. And we should not forget, China's banking system has twice the assets of the entire US bank system. And the whole financial system is filled with troubled wealth management products, shadow banking, high interest loans. We are seeing a property bubble caused by easy credit. So at the moment, there are capital controls which are slowly being put in place. We are seeing that Bitcoin is going crazy, also because of China. There was some articles suggesting that most of the transactions in Bitcoins are coming from China at the moment, and I think that's totally true. We're seeing the renminbi at a 7-year low, so I think there's quite a lot of stress in China, and this will probably also be a topic that will keep us busy going forward. And of course, this will have enormous effects on commodity markets and also on precious metals.
So could the clampdown on Bitcoin in China have a positive effect on gold as maybe assets are shifted towards going into gold rather than going into Bitcoin?
I'm not sure. I think there's many similarities between Bitcoin and gold. And actually, Satoshi Nakamoto, he knows gold pretty well, and I don't think it's a coincidence that you're mining Bitcoins. I think that when it comes to the logo, it's very similar to a gold coin. I think the stock to flow ratio of Bitcoins is really interesting and quite similar to gold actually. So from my point of view, of course, they are competing currencies, and I think in the whole cryptocurrency space, there's so much going on at the moment. I'm really confident about the big revolution that is coming out of this sector. Of course, there's also quite a lot of crap that nobody is going to talk about in a few years, but there is a technological revolution happening, and I think our whole world is digitalized. So why should that end with money? Yeah. Especially in this environment. So I think I'm pretty positive on Bitcoin. I think that it's not either Bitcoin or gold. I think there's room for both. And yeah, I think that the worse financial repression will become, like in India at the moment, for example, the more people will pile into Bitcoins and also physical gold.
Coming back to some of the issues relating to debt, it's been pointed out recently that corporations have taken out a lot of debt to use in buying back their equities, perhaps upwards of $620 billion borrowed in the last 12 months alone. Given the rising interest rate environment, could that trend stop or even be reversed? I mean, if you have a reversal of that trend, that would that not necessitate a large amount of selling on the orders of billions by companies of their stock or issuing more stock?
Very good question. I don't think that they would be reversing, so basically selling their own stock, but I think buying could could stop. I don't think they're gonna start selling, but I think buying could stop, and this would have enormous consequences for the equity markets. And I've said before, the S&P is trading at a P at 20. Having a look at the outlooks from the big banks, of course, everybody is bullish equities again. I think it's very, very thin air. At the moment, I don't see too much multiple expansion anymore, and I think that the corporate world, we're in an earnings recession for 4 or 5 quarters now. I think that some other economic factors like tax receipts, etc., they already show us that actually the economy is not so well like everybody would suggest. So I think that equity markets are very overpriced, and therefore I don't see too much upside anymore. But still, at the moment, for market participants, greed is much more important than fear. But this is going to change very soon, and it can happen. It's hard to anticipate the reasons for such a shift, but it can happen very, very quickly.
Yeah, exactly. And given your approach to investing using the principles of the Austrian School of Economics, what types of generic asset classes make sense? What makes sense in this challenging environment generically? Like, could you expand on that? Like, what asset classes make sense, and why from an Austrian School of Economics investing perspective?
Of course, diversification in such a scenario is not the worst idea. We're doing it in our permanent portfolio concept, where we also got managed futures, for example, that just profit from trades either on the upside or on the downside. I think it's no secret that we're pretty bullish on gold and commodities. We've got a uranium fund that is doing very, very well at the moment. I think that's going to be quite an interesting topic going forward. And I think one really has to be cautious. And the sad thing is that nowadays, when I'm talking to market participants, institutional players, nobody's really talking about business models anymore. Nobody's talking about valuations, about innovation, about products. Everybody is only trying to anticipate what central banks will do next. And I think this already shows you how dependent we are on cheap liquidity and on the whole on the whole let's say central bank bubble not to burst. So I think in this environment, you gotta be. Perhaps you should be overweight cash. You should be diversified. You should protect your downside, and there's also plenty of ways to protect to profit from falling markets.
Are there certain sectors in the equity space that you see as attractive, like agriculture?
Honestly, we don't focus too much on the agriculture space. We just don't follow it because of lack of resources. We really focus on the precious metal space, and some other commodities like copper, uranium, and energy. That's basically what we're focusing on, and I think there's plenty of opportunities. I'm really confident on silver. I think that this is such a tiny market, and if really investments like institutional investors really start buying into the silver space, this will have enormous effects because it's just a tiny market, and so I think that within the commodities space, there's quite a lot of interesting stories. The biggest threat, from my point of view, is definitely China. So one has to be cautious and follow the signs or the numbers that are coming out of China. But you should take them with a grain of salt, because we all know if the Chinese government wants to see GDP growth at 7.5%, it will be 7.5%.
Okay. Yeah. Okay. And what if China evolves adversely this year? Could that have an increasingly adverse effect on emerging markets, particularly in the Asia Pacific region, either on companies, corporate profits, currency values?
Absolutely, absolutely. We're already seeing enormous volatility in emerging market currencies, the Turkish lira, the Mexican peso, of course, and this will have global effects. And normally, crises start at the periphery. Also quite interesting what we have seen before every major market crash. We have actually seen rising rates and rising inflation rates, and we're both seeing both at the moment. So I think that I wouldn't say that that we will definitely see a big crash, but odds are probably much higher than the market is seeing them now.
Wow, shaping up to be an interesting year.
It is, yeah.
Yeah. Well, how can our listeners learn more about your work, Ronnie?
Basically on our webpage, incrementum.li. LI stands for Liechtenstein. That's where we are based, probably the best jurisdiction within Europe. We've got a research distribution list. We're writing the In Gold We Trust report. As you know, we're doing chart books. We wrote a book about Austrian investing. So we are very much research driven, and most of that research is for free, and it's all on our webpage.
Great. Thank you very much, Ronnie.
Thank you very much, Richard. It was a pleasure. Thank you.
Take care. Thank you. Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.